Yeah, the number one thing that I hear when I hear somebody say that and I try to dig with them is, well, it just seems too simple. It seems like, risk is far too complicated to, boil it down to a single number. And I would say we had those debates inside of our company all throughout 2011 and 2012 before we rolled the risk number out to financial advisors in 2013. But ultimately, what we realized and the real power of what Riskalyze does is there's very sophisticated methodology underneath the surface of radical simplicity. And what I mean by that is I would encourage people to go check out riskalyze.com/methodology. We go into it in a lot of depth and explain the approach we take, the data-driven approach we take using historical data in the model. And how, for example, I was just talking with somebody about this yesterday. They're like, well, we're assuming that you break this all down into asset class buckets, and then you kind of look at the historical performance of the asset classes. I'm like, no, actually, we decided, one of the things that we all learned in 2008 is that in times of stress in the markets, all the correlations go to one, right? And so the reality is that all the securities did not go to one. Okay, they actually behaved a little bit differently. So we made this fateful decision back in 2011 and 2012 to architect the platform to go down to the securities level. And so literally when we're looking at the risk of a portfolio, we're taking each individual security and strategy and product in the portfolio. We're using all of its price history, back usually about a 10-year time period. There's a couple different, risk modeling approaches the advisor can choose, but typically going back about a 10-year time frame. And we always wanted to make sure it included 2008. Now we've got the 2020 crash as a data point to have in there as well, right? But you want to have a down market and you want to have an up market in the data set that you're feeding into the risk model. And then we're again, it's not just a simple averaging of that. We're also doing all the cross correlation analysis across the different securities. And so, for example, you could take two stocks that are each a risk 92. And if they were anti-correlated, you could, in theory, have a 50-50 portfolio with those two stocks that was a risk 63 or something like that, right? And so there's a lot of sophisticated methodology under the hood, but the key to our success has been that we built radical simplicity on top of all of that sophisticated methodology. And instead of trying to impress every advisor with our 747 cockpit of 20,000 switches, okay, we created something that was radically simple to use, but most importantly, radically simple for their clients to understand, because we are not in the business of telling advisors how to advise. We're in the business of helping their clients see and understand the things that they have been telling their clients for years.
Radical simplicity. I love it.